Good morning, everyone. My name is Marie Brière. I am the scientific director of the FAIR program, Finance and Insurance Reloaded program at Institut Louis Bachelier, and it is my great pleasure to welcome you to this webinar on cyber risks. With the digitalization of our economies, cyber attacks are becoming more frequent and increasingly costly. In 2020, the global losses from cybercrime are estimated to have reached $1 trillion, more than 1% of global GDP. The European Systemic Risk Board recently characterized cybersecurity as a systemic risk to the European financial system. But despite, could you put your microphone on mute, please? Thank you very much. But despite growing concerns, there is limited coverage by cyber insurance and a need to develop micro and macroprudential regulation. There are key challenges. First, there is a lack of data available on cyber incidents. Attacks are underreported, which limits the possibility to quantify precisely the risk, develop probabilistic pricing, and proper risk measurement. And second, there are questions around the insurability of the risk by the insurance sector. To discuss this, we have the chance to welcome today three distinguished professors. Hélène Rey is professor of economics at London Business School. She will give a guest speech on her recent paper, The Anatomy of Cyber Risk. Hélène is one of the key specialists in macro-financial risk and financial stability. She is a member of the Haut Conseil de Stabilité Financière and vice president of CEPR. And her new research takes an original point of view by proposing a new measure of firm cyber risk exposure based on textual analysis of earnings call Q&A transcripts. We will learn from her talk what are the characteristics of firm the most exposed to cyber risks, how the risk is priced by financial markets, and if investors can hedge it. Then Caroline Hilleret, who is professor at ENSAE, and Olivier Lopez, professor at Sorbonne University, who are the co-directors of a research chair on cyber risk modeling, will give a talk and an overview of the research done at the chair on the modeling of cyber risk, taking into account extreme events, accumulation risk, and contagion effects, and their impact on an insurance portfolio. Finally, these presentations will be followed by a roundtable discussion with key professionals from the field and moderated by Aimé Lachapelle, who is managing partner at Emerton Data. Before we start, I would like to warmly thank our partners, ACPR, EIFR, and Institut des Actuaires, and in particular, Florence Picard, who has been key in the organization of the event. ACPR and ILB jointly organized a series of conferences on digitalization. So I would like to thank Olivier Flich, head of the FinTech Innovation Department at ACPR, for the co-construction of the events program with us. And last but not least, I would also like to thank Louis Bertucci, scientific coordinator of the FAIR ILB program, and of course, Institut Louis Bachelier's team, Stine Feriel, Miriam, and Natalia. Please don't hesitate to make the event interactive by raising your hand or using the chat function, but please don't forget to put your microphone on mute and stop your camera during the talks. So without further ado, let me give the floor to Hélène Rey. Hélène, the floor is yours.
Thank you very much, Marie, and thank you very much for the invitation to address this nice group. So I'm going to present some recent work on the anatomy of cyber risk, as Marie said, and this is very much still work that I am currently doing. So your comments will be also well taken and welcome. I am hoping that you can see my slides. Can you see?
Yes, we can. Perfect.
Excellent. So this recent work on the anatomy of cyber risk is joint with Rustan Jamilov, who is a fellow of All Souls College, Oxford, and with Ahmed Tahoun from the London Business School. Here, it's not worth motivating the importance of trying to understand a little bit better what we know about cyber risk and the characteristics of cyber risk. We are constantly being exposed to hacking and to various events which are being reported and that we can read in the international press and so on and so on. This is an issue that is very much on the radar screen of macroprudential authorities, and so here I have put a quote from the European Systemic Risk Board, who has identified cyber risk as a potential source of systemic risk to the financial system. And this is also a diagnostic which is quite widely shared. The World Economic Forum, there are always some surveys putting cyber risk as one of the main risks that we are facing. And despite, I guess, the importance of this risk, what is still true as well is that we don't know that much about cyber risk, about the characteristics of cyber risks, about its determinants, and so on. And of course, one issue and one reason we don't know that much is because reporting of cyber attacks are not really exhaustive. There is a big problem in practice of underreporting of cyber attacks. Why? Because technically there are some regulatory gaps. We don't have to report. There's no regulatory requirement to report necessarily. And of course, there are huge or potentially huge reputational costs attached to cyber attacks, and therefore the incentives to report cyber attacks may not be there. So the actual extent of cyber risk may be quite underestimated by existing databases, which are about realized cyber attacks. And this is why what we try to do in this work is to go to another source of data in order to learn more about cyber risk. And the source of data that we are using are the earnings calls of a wide panel of firms, of listed firms. And in particular, what is of great interest are the Q&A sessions with investors every quarter, where questions can be quite unexpected and spontaneous, and investors can push firms to discuss issues. So we have analyzed a large number of transcribed files of these earning calls, more than 300,000, using textual analysis and very simple algorithms, which enable us to locate in the transcribed files some key terms linked to cyber risk. So we started by constituting a dictionary of cyber risk terms, containing all the obvious terms from cyber risk, data breach, ransomware, etc., etc. We use some documents to construct our dictionary, but of course this can always be improved, and we are going to improve our algorithm by adding some additional terms in the next weeks. We cover, and this is one interesting characteristics of this data set, it covers a number of countries. It's not only US firms, as some work has covered so far, with some other data sources. Here it's a broad panel, so we can look at comparison across countries. It's quarterly data. And we can do more than just identifying terms linked to cyber risk. We can also looking at other terms in the neighborhood of discussions on cyber risk in the transcripts, and see whether the sentiment around those terms is positive or negative. So we can assess, we can construct a measure of sentiment with cyber risk. And we can also associate other terms with cyber risk, hacking, etc. We can look at monetary loss, insurance, and any kind of global events we might think is interesting to measure by association with cyber risk, as well as try to identify some potential geographical location of cyber risk, both origin and destination. So what do we find when we do this? I would call that a rather, at this stage, descriptive work on cyber risk. There's a couple of findings which are worth, I think, reporting here. The first thing is that global exposure, so our measure of exposure to cyber risk is growing rapidly. The fraction of earning calls discussing cyber risk has increased 5-fold in 15 years. Our measure of sentiment associated with cyber risk is down, and with many mentions correlated with cyber risk are relating to monetary loss, insurance cost, etc. What is quite interesting also is that we see that there is a geographical variation over the period that we study. And in particular, we see that cyber risk seem to have, well, it's growing everywhere, but it has shifted in relative terms somewhat from the US to Europe and Asia. The industrial composition has also shifted, and there is an increasing share towards the financial sector. Now, one may ask, but how do we know whether our textual analysis measure is actually any good? Well, one external validation that we can do of this measure is to see whether it can help predict actual cyber attacks, at least the ones that are reported, right? And so we check that and we find that it does that. Another interesting, of course, study that we can do because of the nature of our data is that we can relate our cyber exposure measure to the characteristics of firms and to see which firms are the ones which are more likely to be subject to high cyber risk exposure. We find that on the whole sample, the firms which are most at risk are relatively large, liquid, with high share of intangible assets. But there's a lot of heterogeneity, as I will point out. We also can identify by looking at stock returns of firms in our sample, we can identify the effect of high cyber risk exposure on the returns, and it is a negative effect. But interestingly, we also are able to see that it's not only the firms which is highly exposed to cyber risk whose returns goes down, but there's also a contagion effect with firms in the same country sector at a very fine level, also affected by exposure to cyber risk, even though themselves they may not have any mention of cyber risk in their analyst call. So they are themselves not directly exposed, but they are indirectly exposed. So let me show you a few results now that I've given you an overview of what we have here. So the type of terms that we use in our textual analysis, you have linked to cyber risk. So you have here a kind of overview. We can, of course, add a lot more, but this is a kind of dictionary that we have. We built it from the Carnegie Endowment for International Peace documents, and of course can refine that. The methodology is very easily adaptable. Once we identify these cyber terms in the text, what we do is that we look in the neighborhood. The neighborhood means within 50 words of any of these topical words. And there we look at bigrams. So bigrams means other terms that, if they are within 50 words, are going to be considered associated with our cyber risk indicator. And among the bigrams that we try to identify, so I already talked about terms which are linked to the sentiment. So there is a very large dictionary of terms linked to positive sentiment, a very large dictionary of terms linked to negative sentiment. And so when they are in the neighborhood of a cyber risk term, then we associate it with positive or negative sentiment. We do the same for geographical locations. We do the same for terms associated with monetary loss, insurance costs, etc., etc. So this is the way we construct our data. Just to give you an example here, so there's a lot of snippets like that. So this is a snippet from an earnings call transcript, which is used to the massive Equifax data theft that occurred in 2017. And so here you see that there are lots of terms associated to cyber risk and breach, and the sentiment is very negative, incidents, difficult, etc. So this is one example of an event, a big event, which is picked up, and then we construct exposure, we construct sentiment from our indicators, and this gives us 1 point for our measure. We have similar things here, for example, for the target attack, where there were over 100 million individuals who were exposed to that attack, a lot of data that was compromised, emails, addresses, etc., etc. And so here again, we have a massive data breach, which is being picked up, and we have a lot of negativity in the description. We have challenging, we have costs, we have slowdown, we have lots of things, restructuring, etc., etc. So that would be the target one. We also had in 2019 Capital One, for example, and again we construct our exposure score and sentiment score there from the counts of all the bigrams, where we had unauthorized access to personal information in Capital One credit card customers. So again, this is picked up, and the same type of terms come up as well. So now we have lots of those, and when we put them together, we can, for example, look at the geographical distribution year by year of cyber exposure and cyber sentiments and any kind of cyber-related indices that we may want. So here I'm showing you the map, the heat map of 2010. So here you see that the darker colors are associated with more cyber risk exposure, and we see here that cyber risk was centered really with the US, the UK, but Europe was relatively light color. As we move forward, 2015, we see that we have more countries which are being affected. And if we move to 2020, we see again that the colors become darker, and that there's a propagation of cyber exposure, or more cyber exposure by a number of countries, including in Europe, including France and the UK in particular here. We can also look, and I'm not going to spend any time on this, but we can also look in the US state by state, for example, because we have the location of the firms. And there what we see in the US is that there is more cyber exposure, of course, maybe in California and also on the East Coast. The two highest states are California and Virginia, it looks like, but we are also Illinois in the middle, and we have Texas, who are quite affected, Arizona. Interestingly, if we look at the cyber sentiment heat map, this is very non-uniform. So, for example, California, which is very affected, has a very negative sentiment. But if we look at Virginia, which is also was also very affected, it has a positive sentiment, maybe because of the presence of IT security firms, which are located there, and maybe dominating the chatter. So these are interesting aspects that one could study further, but we don't have much time. So another thing that we do here is we try to look at origin and destination of this cyber risk exposure. So there is some uncertainty, of course, because we pick it up from the proximity of the words to the cyber risk term. What seems to that we seem to see in the data is that there is a lot of flows, so origin and destination of cyber risk between, of course, the US, the UK, but also North Korea, Russia, China, Iran, Israel, and also other European countries. So there is a number of arrows which are thicker than others. Of course, this could be investigated also a lot in a much more refined way. This is something we are planning to do, but this is a first shot at that. Now, and maybe I could have started by this. I'm showing you here the time series of the global cyber risk exposure index that we built using our textual analysis measure. And just put to illustrate a few famous events here on this time series. So it is you see that whether we measure it by the mean of cyber exposure or the percent of calls with cyber exposure being strictly positive, we get roughly the same picture. We have a big increase in cyber exposure, in particular after 2013. And after that, so we have a number of famous events. We have in particular the famous Petya, and then the NotPetya, and then Equifax that showed you some snippets, WannaCry, etc., etc. So we see a pretty strong increase, especially after 2013, on cyber exposure here across our sample. What we investigated then is whether that index of cyber exposure correlated with other measures of risk that had been studied using the same sample of calls, of analyst calls. And in particular, there's a paper by Hassan et al. Who looks at political risk using the same style of tools and the same sample as ours. So we looked at their measure of political risk, which is in blue, together with our measure of cyber risk. We see that maybe at the beginning there was a bit of a correlation, but after 2013, cyber risk completely takes off and is quite distinct from political risk. If we look at another conventional measures of risk in financial markets, the VIX on the right here, as we can see, the VIX doesn't seem to be correlated with our measure of cyber risk. And if we decompose, again, the measure of political risk in more finely in technological component and trade component, there's not much of a correlation. Maybe in the beginning of a sample there was, but not since 2013. So to us, that suggests that cyber risk is quite a distinct risk factor, at least in the minds of the analysts and people who are taking part of these calls. It's very different time series property than other conventionally analyzed risk here. We look at cyber and uncertainty by putting together these diagrams and descriptions of uncertainty related to this cyber risk chat, and we find this time series with a massive increase again of uncertainty associated to cyber risk after 2013. So again, this time series behavior with a large increase after 2013 shows up very strongly here in the uncertainty world. The net sentiment is going down also in our measure, meaning that not only there is an increase in uncertainty associated to cyber risk, but the sentiment surrounding cyber risk is increasingly negative in the conversations. Maybe not coincidentally, at the same time that the sentiment is increasingly negative, we also have an increasing occurrences of association of cyber risk with monetary losses terms and with insurance and legal terms. So this is all quite consistent, and you can see the high correlation across this series. Okay, I'm going to pass on this because we don't have much time. One thing that we plan to investigate a little bit further is that we have lots of graphs, by the way, in the paper, and we are going to update the paper in the coming weeks. So if you're interested in all these graphs, I will refer you to the appendix of our paper. It's potentially interesting to investigate the correlation between valuation of cryptocurrencies and cyber attacks. As we know, a lot of ransoms are paid in cryptocurrencies, and so the time series is a bit short so far to say anything, even though we tend to see the peaks of the valuation of cryptos do seem to coincide with also more important activity in cyber risk. But I think this is something that can be investigated in a lot more detail. Okay, so how about this geographical distribution that I was discussing? Well, so here, this is just a bar chart that says the same as the heat map. That is to say, in terms of relative share, cyber risk has gone more relatively towards Europe and the UK and also Asia than at the beginning of the sample. So we see a kind of move of cyber risk towards the east. And if we look at the industry composition, which is something I haven't shown you so far, what I think is interesting is that we see, so of course we have a lot in IT, we have a lot in, we had a lot in manufacturing, or relatively large amount in manufacturing, and services. And now as we move towards the more recent period, it seems that the financial sector is getting more important in relative share. Okay, so that's the financial sector. And if we divide finance in sub-industries, it also seems that insurance is becoming an increasing target compared to the banking sector. The share of insurance seems to have grown. So this is also an interesting maybe development in terms of the anatomy of cyber risk. Right, so is our measure good for prediction, realized attacks which have been reported? The answer is yes. So if we run here a logic model and we use our cyber exposure index to predict whether there's going to be an attack or not based on the reported data, we do see a significant link here, and this is true for the cyber exposure, but also this is true for the negative sentiment cyber, which also shows up. This is true for cyber and insurance, cyber and loss, so they're all significantly associated. Uncertainty is not, but the others are associated in a consistent way. So that gives us some external validity of our measure. And this is here the kind of intensive margin of prediction, where if the cyber risk exposure is higher, in the sense that there is more mention of cyber risk, then the more mention there are, the higher the probability of a cyber attack. Of course, the confidence intervals become wider because there are few firms in which there is a lot of mention of cyber attacks. Okay, but this is also consistent with predictability and with what you would expect. Quickly, because I'm already, I think, almost running out of time, we look at the determinants of firm-level cyber risk exposure. And here on the whole sample, what we find, and this seems to be driven, by the way, a lot by the manufacturing firms. So there is some sectoral heterogeneity here, and also some geographical heterogeneity. So this is to be taken with some caution. What we seem to find is that firms which have higher intangibles, which are more liquid and which are larger, seems to be more likely to be attacked. So this is something that we seem to find, and as I said, it seems to be driven to some extent by the manufacturing sector. We don't have time to go into details. There are some interesting heterogeneity, in particular in the financial and insurance sector, where the results are quite different. And it would be nice to understand a bit better why and what is driving these results. So this is something, again, some work to do there. I just want to show you this, because I think these are quite striking, these results linked to the contagion effect I discussed at the very beginning. What we did is that we looked at the effect of cyber exposure on stock returns, on weekly stock returns of firms, whenever they are exposed to cyber risk. In a given week, what is the effect on their stock return? And what we find is that the affected firms, so the ones which are directly exposed, see a weekly return decreasing by its 0.3 basis points here. Because of cyber exposure. So each time there is additional mention of cyber risk, it's a 0.3 basis point decrease in their stock return. Interestingly, if we have firms which are in the same industry at the 6-digit level and the same country, even if they are not directly exposed, there is a contagion effect on their stock return. So this is what is presented here in the peers column, column 4. So the effect is in magnitude a bit smaller, but it's there. While
vous avez été mis en attente. Ne quittez pas. Votre correspondant va vous reprendre.
If you could put your microphone on mute.
Yeah, it's not mine, I guess. Okay, and if we look at non-peers firm, you see here nothing. So these are the firms in the same country, but a different industry. There is no contagion effect. So that there seems to be a pretty precisely identified contagion effect here. Okay. Now, the last thing I will conclude with is that this is just a monthly pricing factor constructing from our cyber exposure measure here. And we were interested to see whether this pricing factor would correlate with any of the standard pharma French factor, and also with the prices of some of the cyber security ETFs that exist. And so, to our kind of surprise in a way, when we looked at the monthly returns on two of these ETFs, what we find is that they are mostly correlated with the market, a little bit with size, but mostly with the market, but that they are not correlated that much at all with our cyber risk index. So it seems to us that it's therefore a bit unclear what these cyber security ETFs, how they are priced. Something again to investigate further would be great, very interesting.
Vous avez été mis en attente. Ne quittez pas.
To conclude, I think so. What we are trying to do is to use these earning calls, because these are probably a more comprehensive source of data for cyber risk exposure. We construct various measures of exposure and also of bigrams, association of cyber risk with various different topics and terms. We find strong increase, especially after 2013. We also find some pricing of the cyber risk exposure on affected firms, some effect of contagion effect also on other firms. Which makes the cyber risk shock potentially a bit more systemic than and not idiosyncratic. I think there's a lot more to do on the characterization of which firms are associated and in which sector with cyber risk. We started that, but we can do a lot more also on the geographical implications, and obviously all the asset pricing implications can be also explored with a lot more detail. So let me stop here and I will unshare the slides.
Thank you very much, Hélène, for a fascinating presentation. So please don't hesitate to ask your questions through the chat. I see there is already one question by Aimé, and I have also a few questions to ask you, Hélène. So I will gather all that together, and if there is more to come, I will give the questions all in one. So first of all, I would like to insist on the key insight of this paper for investors. I'm working for Amundi, so I'm particularly sensitive to this insight. So I think what you're showing in this paper is that investors should really care about cyber risk. So you show that affected firms, they suffer lower returns, but also what you show is that cyber risk is a priced risk factor. And you have this long short portfolio where you play low cyber beta stocks versus high cyber beta stocks, and it pays 3% on average per year. So it's a quite consistently priced factor. So I think that's quite interesting. And what is also interesting is that the risk seems to be difficult to hedge, at least from standard investment products, because you show that there is no association between the cyber risk factor and the cybersecurity ETF return. So how can we hedge that? It's still an open question. So I think there are also a lot of insights for supervisors. And then I would like to ask you one question, because when we prepared the panel, we were discussing around that. What's the correlation between cyber risk and traditional financial risk? I think you have this information, but we don't see the correlation because you only show the alpha when you're looking at these regressions of cyber risk on market and pharma French factors. It would be interesting to show the correlation, but also with other market factors like fixed income, etc. And the reason why I'm asking that is that this correlation has not been properly modeled in standard formula under Solvency II regulation. And maybe this is something we discussed with Olivier Meillan. He will maybe come back on that later on. This is maybe an open question if that should be properly modeled. Another very interesting insight from your paper is that we understand a little bit better maybe these interconnections between firms and sectors, and maybe that would help us better model potential contagion dynamics, which is something that Caroline and Olivier are investigating from another point of view. So your paper shows that there is financial market contagion, right? Firms of the same sectors, they suffer losses, even if they are not directly affected by a cyber event. But on that, I have two questions. Does the market contagion reflect as well sometimes real cyber contagion, meaning on the cyber incidents or the cyber exposure? So did you also try that? And another question, is there intersector contagion? And I would be really happy to see a map showing interconnections between sectors. I think that could be quite useful, because we'd like to understand how systemic is the risk, right, compared to other financial risks. And then I found the results on the predictability really fascinating. So you find predictability at the firm level, so it's quite fascinating. So I would like to ask you, where does the predictability come from? Is it coming from repeated attacks? So firms are attacked one time, a second time later on, and that's the reason why you find predictability. Then I thought about maybe another rationale, which that insured firms talk about their insurance, for example, and then maybe they are more prone to an attack. And you've seen the debate about insurers paying the ransoms, for example. So maybe it could lead to more attacks. So these are two different channels, lead to completely different consequences as well. So these are for my questions. And then I see that Aimé has also some questions that I'm going to raise. Let me start with the first one. On the methodology, have you tried topic mining techniques for which the word association is inferred by the algorithm rather than predefining bigrams? He has a second question. You show that the indices have a predictive power on future cyber attacks. Do you observe autocorrelation on cyber attacks? So I think that's a similar point. And when I made, firms from the same sector geographies that are attacked tend to be reattacked. Couldn't this effect be captured by the reported attacks in official text document? And then he has a third question. Do you think that insurers could leverage such indices to underwrite price policies for example, for SMEs? So I will stop there, and maybe if there are later questions, I will ask them in a row.
Wow, these are fantastic questions. Thank you so much. I'm not sure I can answer all of them, but this is certainly things that we will take up in our ongoing work. So on what this risk correlates with, so yeah, I showed mostly correlation with a number of time series of political risk, various types of political risk, quite cleanly identified at the firm level, because they are also, there are these research papers using this same database on analyst call and doing quite a careful job at identifying the risk at the firm level and also validating it with external measures. And also the things like the VIX, etc. So there we really don't find that much correlations. That means it's picking up something else. Now, in the paper, we also look at the correlation with Fama-French factors. So I don't fully recollect everything here. So there is some correlation, but I don't remember them being especially high. So, but this is there's a table in the paper. And of course, I mean, what is a bit puzzling so far is this results on the ETFs. And so this is something we plan to investigate in a little bit more detail. But it does look like there is some independent risk here in this identifying this cyber exposure index that we are producing. So it cannot be put in a box apparently. I think looking at so we look within sectors at contagion. Looking intersector would also be extremely interesting. Now it would be, in order to do that in a way that is informed, we will need to have relatively granular information on some types of links between firms that could be links which go through their, their production network. But there could be other types of links that could be explored, like people using the same insurer or the same auditors or these type of links. And that would be extremely interesting. We don't have the data to do that right now, but this is something that indeed could be looked at. Where does the predictability come from? So now this would be, I don't have a feeling that this comes from correlation, from time correlation of attacks, so that you would have repeated attacks on the same firms. But this is something we could investigate formally, and that's a very good idea. So we will look at that. Also suggestions on letting the data tell us associations instead of predefining diagrams is also a very good idea. So we can also definitely look at that and see whether anything would come up. And I will leave the question on the insurance to the people who are actually in the industry.
Okay, thank you very much, Hélène, for your insight. I see we have 2 other questions in the floor. Could you please ask them, Florence, maybe, and then Yvon, quickly in a row, because we are short of time. Florence? If you want to ask your question, you need to unmute you.
No, thank you very much.
We don't hear you. Florence, we don't hear you. So maybe Yvon, if you would like to ask your question. Okay, there seems to be some issue here. So, okay, so let's maybe move to the second talk, and then we'll get the questions afterwards if the issue is solved. So thank you very much again, Hélène. And Caroline and Olivier, are you there? If you want to share your slides.
Yes, we are here.
So thank you very much. The floor is yours.
Okay, thank you, Marie. Thanks a lot for the invitation. With Olivier, we are very pleased to present here an overview of our main contribution concerning the topics of the actuarial modeling of cyber risk. And in fact, those contributions are part of a joint research initiative, which is called Cyber Insurance Actuarial Modeling between our 2 institutions, NSAE and Sorbonne Université, and the Group Risk Management of AXA, and which is under the aegis of the Risk Foundation. So as Hélène Rey already mentioned in her talk, cyber risk is in fact a risk with multiple facets and which has multiple dimensions. There are, of course, various types of attacks, ransomware, which is nowadays very popular, phishing, also classic frauds that now use numerical paths, and many others. We have seen some of them in the talk of Hélène. There's also a variety of targets. One can say that no one is spared or immune. Individuals can be struck, but also small, medium, and big companies, and public administration and states are also targeted by cyber attacks. So the cost is huge. Marie mentioned it in the introduction. It's estimated today to more than 1% of the global GDP. That is $1 trillion. And in fact, it seems that this risk is growing. For example, in France, the number of ransomware that have been reported to the ANSSI, so the ANSSI is a French national agency for the security of information system. So this number of ransomware reported to ANSSI was multiplied by 3 between 2019 and 2020. And if we concentrate on insured claims, and especially for large enterprises, and using the study Lucy of AMRAE, we see that for large enterprises, there's not necessarily an increase of frequency between these 2 years, 2019 and 2020, but we observe an increase of the severity with ratio claims over premiums that almost double between these 2 years, and this is due mainly to 4 big claims, big events. Maybe to illustrate, we have seen in the talk of Hélène some case of attacks. So here we focus very quickly on this example of a major attack, which is the attack on a Colonial Pipeline that took place last May. And it has targeted this major fuel provider in the US. So in fact, it was a double attack. First, a lot of data, I think it was more than 100 of gigabytes of data that were stolen. And the day after, there was this ransom attack that forced Colonial Pipeline to stop all its activity and to contain the attack during a few days. So, of course, this attack had several implications. It implied an increase in the oil prices, more than 4%, for example, of the Brent. But there were also a lot of cascading consequences in the supply chain. So first of all, of course, there were fuel shortages, and this has caused perturbation in the supply chain for the fuel, and also perturbation in some airports. For example, an airport, Charlotte Douglas, should stop during a few years, a few days, and it also caused that's forced airlines to change their flight schedules and so on. So in fact, as a consequence, it's forced the president of the United States to declare a state of emergency 2 years after the attacks. And behind the attack, there was this group, this hacker group, which is called DarkSide, which is a criminal hacker group, and which is a ransom provider. It's a ransomware as a service. So it shows with this attack Colonial Pipeline that the job of hacker is more professional, is more organized, and one not need to be an IT expert now to launch an attack. So facing this risk, insurers will have an important role to play to help for the resilience of this economy. And nevertheless, the evaluation of this risk is very difficult. We have similarities with operational risk, but some specificities that really should be taken into account to accurately evaluate and this risk. So first, this is a risk that is relatively new compared to other insurance risks, and that evolves very fast. We have also the issue of silent cover, of silent cyber. That means that there is policies that are not dedicated to cyber events, but whose guarantees can be triggered in case of a cyber event if they are not explicitly excluded in the policies. So one have to be careful and to rewrite some others' policy. And as we have seen with Colonial Pipeline, and so with the data in the study Lucy, we have exposed to extreme events with huge losses that can occur. And in addition to this severity risk, we have also accumulation risk or systemic risk, that is potential concentration of incidents, which can lead with this severity risk to a loss of mutualization, which is a major issue for insurer. Olivier.
Sorry, I must unmute. And so next, just to show, first of all, a classical approach in actuarial science, which is when you have a risk, you try to have a frequency severity analysis. The frequency, it's typically the number of claims that occur during some period. And then once claim occur, you have a random loss, which is here the variable y here that is underlined. So typically, when you are trying to evaluating a risk in order to build some insurance product, you have a first task, which is pricing, and which consists in equalizing the premium here with some average scenario. That is, you look at the average number of claims and the average loss of each claim, and then you have the pure premium. Of course, in practice, it's not so simple as mathematics. You also have competition between insurers, and when you are doing pricing, you must adapt. So maybe the final price will be very far from this mathematical price. But another very important question is the part regarding reserving. That is not only evaluating the central scenario, but also being able to identify how much amount of reserve you must constitute in order to be able to survive to some events that are pessimistic compared to the central scenario, but not so pessimistic in the sense that their probability of occurrence is relatively high, at least high enough to create some worry. And so, in fact, when you are looking at this question of reserving, which is particularly important in the case of cyber because you have a risk which is very volatile, typically you are looking at the tail of the distribution. That's the field covered by extreme value theory. And in this case, if you look at losses regarding cyber incidents, that is the variable Y I mentioned, you fall into a world where this very concept of volatility that I mentioned is sometimes not even defined, at least not in the same sense as in finance, for example, because when you are looking at heavy tail distribution, you have a quantity that I do not define here, but which is well known by statisticians. It's the tail index. It's a measure of the heaviness of the tail. And if this index becomes too high, you lose the very concept of variance. And sometimes you can also even lose the expectation. So you may say that it's maybe purely theoretical, because in fact, in practice, you can remove this question of the tail by introducing some limits in the policy. You do not pay more than a level that is properly defined. But in fact, this gamma parameter, this tail index, has an importance when you want to define a limit which is enough to ensure that you will survive with a significant probability to some catastrophic event. And so even with this trick of limits, this gamma parameter is important because it will tell you if you are able to cover properly the risk, if you are able to provide some coverage that is useful, sufficiently useful for policyholders. And the big question here is that gamma is a really nasty parameter in the sense that when you have some heterogeneous population, typically here you have two populations, a population with a small gamma and another population with a high gamma inside your portfolio. If you do not know which population is which, you will tend to estimate a gamma close to the worst case scenario. That is, if you mix population, some are really bad related to the tail of the distribution and some are better, then statistically speaking, you will see, you will tend to conclude that the situation is the worst possible. And then you will typically penalize some policyholders for which you could provide a better coverage with probably a limit which would be more efficient for them and for you. And so you penalize by not being able to identify, to classify in your population these two types of risk. And typically, that's something we're looking in our work. Right now, there are technicals, data science technicals that allow to perform such classifications. But let's mention that the key issue here to perform this task, which is very important because it will allow to improve coverage of everyone. The key idea is that you require lots of data to be able to identify, to classify policyholders with respect to the tail of the distribution. And it's not only a question of big data, it's also a question of reliable data in order to have a proper classification. And so, Caroline.
I unmute me. Thank you. So after the severity component, one slide on the frequency component, on the modeling of the frequency component. So in insurance, it is usual to model this frequency component by using a Poisson process. In fact, this Poisson process assumes that the inter-arrivals tau n minus tau n minus 1 between time of events, time of claims, are independent and with the same law, which say IID, dependent and identically distributed. But unfortunately, for cyber events, when we look at data, it seems that the standard model is no more accurate because we observe some clustering effect and some autocorrelation between events. So to capture this phenomenon of autocorrelation and clustering effect, we can use a more sophisticated model and Hawkes model. They are in fact are already used in many areas. For example, they are used in credit risk to model contagion. So what is a Hawkes process? What is Hawkes modeling? So in fact, it's a process that is a self-exciting process with a stochastic intensity lambda, and the intensity it's also called the hazard rate. So I recall here what is the definition, mathematical definition of this intensity. So in fact, it's a conditional probability that new claims arrived around time t, given that it has not occurred before time t. And for a Poisson process, this lambda, this intensity is constant. It can be deterministic in case of inhomogeneous Poisson process. But for Hawkes model, this intensity is stochastic and is fully specified by the counting process itself, the process that counts the number of events, the number of claims that arise. And for Hawkes process, this lambda has two parts. The first part, which is here the lambda 0, it's the intensity of a spontaneous event. And the second part, which is this sum that is indexed by previous events with a function phi, which is an excitation kernel, which is a positive function. That means that every event will increase the intensity, will increase the probability for a new event to occur. So with this model, we have investigated several questions. So first, of course, a different methodology to calibrate different kernel. We have also investigated the projection of the risk. And finally, we have given some formula, some expansion formula to compute prices of cyber contracts that are indexed by Hawkes process. And beyond this Hawkes process, we have proposed other alternative to capture this contagion and systemic risk, accumulation risk, and using accumulation scenario and by constructing accumulation scenario of a cyber pandemic and using this time models from epidemiology. So maybe to illustrate this loss of mutualization, where there is no more independence between policy holders, we have this picture, and we can do this as an analogy with, for example, natural catastrophes risk. So, for example, here, if this picture represents my portfolio, then all my portfolio will be overwhelmed with this one single event, this one flooding, because I have all my portfolio maybe along the same river. And to overcome this situation, so the insurer knows that they have to do geographic diversification. For example, they will not insure all the houses here at the same time. But the challenge is more difficult for cyber because for cyber, how to define proximity and how to construct, let's say, a cyber zone to be able to do some diversification. So this is what we want to try to answer, at least partially. And we have proposed a construction of accumulation scenario using contagion models and with network effects. So these models are inspired by compartmental epidemiological models, namely here the SIR model for susceptible, infected, recovered, or removed. And with different subpopulation, we have seen that the risk is very heterogeneous. So we want to be able to consider in our model different groups, different subpopulation that can, for example, represent a different sector of the economy, but many other situations, in fact, can be implemented. It depends on what we want to model and what we want to capture with our model. So here in each group, we have, so maybe we can come, we have susceptible in green, infected in red, and removed in yellow, and susceptible at the contact of an infected. Inside its group, it's the same group, let's say the group 1, will be infected with an infection rate beta 1,1, and it also can be infected in the contact of an infected on another group, let's say group 2, and with another rate, beta 1,2. And the matrix beta will model, will materialize the infection rate and the connectivity between different subgroups. And of course, one can add in this model different components, for example, to take into account initial attacks that can trigger one subgroup or different subgroup of our population. So maybe, yes, next slide. We have, with this model, we have first test different topologies of networks, that is different connectivity matrix B, and to quantify their impact on the spread of an attack inside a population, inside a network. So we have draw some big squares with small colored boxes inside that represent, in fact, the topology of the connectivity matrix B. So it uses its map analogy. The more red is the box, the higher is the infection rate, and a green box will correspond to a low infection rate. So we have tested different class of topology. Here we just put two cases, a clustered case where the transmission is essentially intern to a class. We see that the diagonal has a red box, and at the opposite, non-clustered cases in which in the diagonal it's green boxes. So this means that the transmission is, the contagion is stronger from one class to another than within a given class. And what can observe in our numerical simulations that the non-clustered situation is in fact worse than the clustered one, since the outbreak can rapidly spread from one class to any others and can rapidly contaminate all the population. So of course, these are examples. We can test several different topologies and their impact on the contagion, and we have also tried to fit this model using OCDE data.
Okay, so yes, just to recall that the key issue here is a matrix here giving how a category of policyholder, a category of industry tends to contaminate other categories. That's this list of coefficients. And typically, what we tried to show in our paper, it's a possible calibration of this matrix using, so do not pay really attention to the number, it's more the methodology which is important. But typically, we made the assumption that the economical connections between different sectors of activity were also correlated with their connections in the digital world, in some sense. So it's just to show that with very few macroscopic data that you can gather, you are able to calibrate relatively easily such a matrix, materializing, you see, sectors that tend to contaminate more the other. Then once you have this type of calibration matrix, you are able, for example, to simulate cyber episodes in which here you have a sector, it's the mining sector here, which is initially targeted by hackers. And then you can see that the attack spreads, the consequences of the attack spreads to other sectors at a given rate. So just not showing all result about that, but just to about this methodology, what are the questions that can be answered? Typically, what we can do with such models is first performing a ranking of sectors of activity. We can identify which sector is the more vulnerable, in the sense that if it is attacked, other can be rapidly also impacted. Also, an interesting question, it's this quantification of the peak. It's true for biological epidemics. We are all looking at the peak of hospitalization, contamination, and so on. But here in insurance, it's also interesting in the sense that very often you must also ask, have you the ability to assist all your policyholders at the time they are infected? If you have some delay in the assistance, it can generate some additional loss. And so that's why it's important also to have a dynamic view of the episode, not only getting the final number of infected. And once you have this vision of the communication between sectors or categories of policyholder, you can use this for diversifications and also to improve the protection, the prevention that we make, in the sense that you can also identify sectors that are very useful, because if you protect some key sectors, even if they are not struck by the infection, the cyber infection, they can lower the final number because they have some particular role in the spreading in the structure of the network. And also, very important issue, we do not have time to expand a lot about that, but a key question is also the reaction of the targets. For example, here you see some type of simulation that we do with our tools. So what you see here, it's a line which increases and which corresponds to the number of policyholders infected by a WannaCry type incident, in the sense that we try to simulate, to replicate a WannaCry type incident. And then depending on the reactions are given by different colors. What does it mean, reaction? This means identifying the attack and also identifying solutions to solve the problem. We can see that if we react fast or less fast, it can have consequences on the final number of policyholders infected, but also on the size of the peak. So it's a key issue to be able to model also this human reaction from a crisis. So it's this conclusion of this overview of our work. You can find more in the paper that are mentioned here. We will communicate the slides to anyone that want to see them. And just maybe a final word. We have talked about different techniques that are promising to study to better understand the risk. But of course, the key issue is to feed these techniques with appropriate data, not too complex, because we see that there is a lack of reliable data on the market, but still that needs to be unbiased if we want to have a proper view of this risk. So thank you.
Thank you very much, Olivier, and thank you, Caroline, for a great presentation, very clear and very comprehensive. So please don't hesitate to ask your questions in the chat. Maybe I can start with a few remarks. I think what we learned from your talk is that cyber risk is very special, right? It's extreme risk, so large tails of the distribution because of these extreme events, high volatility, clustering of events, and there are contagion effects. which are very important to understand because they can lead to a lack of mutualization for the insurer. So the cyber risk gather all possible drawbacks, if you want, right? So it's really problematic. And on top of that, you highlight that there are problems related to heterogeneous populations. So it's very important to classify them in subgroups to have an adequate pricing and improve the coverage of the insurer. So I think that the work you're doing on modeling the cyber risk is very helpful for insurers to compute the price of cyber insurance contracts, to understand which sectors, categories of policyholders are more at risk, and when identify the peaks, and also simulate how they can react to an attack. And finally, understand how you can segregate or classify clients in an efficient way to keep mutualization and offer the best services, the best pricing. So I think it's very comprehensive work on very different aspects. Maybe I can start with the first question on, I found your work on the contagion very interesting. And I was wondering if that could not be very interesting to use another source of data than the OECD, because the OECD is identifying the origin of the value added in final demand, right? And now we have access, for example, FactSet is providing that on very granular data on the supply chain relationships at the firm level, because I think you have access, the OECD data is at the sector level. So I was wondering if you thought about that and using this now available data that is more granular in your work. So I will start with my stop here with my question. So let me see later on if there are questions in the chat and if you could maybe comment on that.
Yes, perhaps a short answer. Of course, what we wanted to do here was essentially to illustrate a methodology with rough classes of policyholders. Of course, it would be very interesting to have a more precise granularity in order to see more connection. For example, in the example that we gave, we have the services sector, which is very huge and which contains companies that are very different from each other. But of course, if you increase granularity, you increase also the estimation variance of the coefficients. So that's a compromise that should be taken into account. Also something related to the supply chain. What is maybe the next step of our work is also to look, here we are looking at a contagion that is purely digital. But then the Colonial Pipeline is a good example. If you have a company that is stroke, you also have contagion in the supply chain. And so, of course, it's not the same dynamic, it's not the same time scale, but right now we are looking at modifying our model in order to take these two components into account.
Yes, Hélène is asking, can you pinpoint which are the channels of contagion? So related to what you just said, Olivier.
You mean the digital one or the...
Yes, the various one, because you mentioned there could be various channels of contagion. So maybe it could be interesting to have like an overview of what can be the different channels of contagion. What do you identify as potential channels? Because you mentioned supply chain channels, but we could also think about, you know, there were questions around you know, these web services platforms that can be attacked and then also lead to contagion to their clients. So there are various types of contagion that we can think about. So did you already think about classifying them?
Classifying them, no, but clearly we identified that there were different types of contagion. You have, for example, a virus which is sent to a company and then that uses the connection of this company to spread across the network, of course. But you also have different types of infections that cannot necessarily be modeled as we did. If you consider, for example, an attack on a cloud provider, here you have almost instantly everyone that is stroke, and you do not have this this effect spreading the contagion. It's instantaneous. So that's a different dynamic, and of course different types of models that you can use.
So maybe in our model we have, of course, this connectivity matrix, this beta matrix, but we have also the typology, I will say, of the attack, and we can implement different type of attack depending on the dynamic of attack. In our paper, we try to mimic, because calibrate, it may be a too pretentious word, but to mimic a WannaCry attack using some data we had on the net, and especially the payment and ransom on Bitcoin. So we can adjust or play with these two components, the connectivity matrix beta and the type of attack that we have in the dynamics, in the model of the epidemiological model, for example, here, but we can adjust or fit more. We have flexibility in these two sets.
Very interesting, thank you. So I think Aimé Lachapelle has a question. So Aimé, if you would like to enter, I think it's a perfect time to give you the floor to moderate also the next part of the seminar. Aimé, would you like to ask your question directly?
Sure, or maybe I will keep it and ask it during the roundtable. Probably better since we are running a bit. Well, I think we're perfectly on time, and we'll try to keep the timing.
Okay, great. So Aimé, the floor is yours. Thank you very much, Caroline and Olivier, and we're looking forward to the panel.
Thank you very much. So maybe I will ask to the panel participant to connect their video. And I also noticed that a few of us have the video on, but they are not participating to the panel. Could you remove your video, please, so that we see all the participants? All right. Maybe Jade, you have your video as well. Herbert also, you can remove it. So I'm just talking about speakers to put their video on. For others which are not speakers in the discussion, could you remove your video, please? All right, okay. All right, so thank you very much, Caroline, Olivier, Hélène, for these talks, very, very exciting talks. Following these two presentations and to react on the various insights that you were able to expose, we are glad today to have experts around this video from various backgrounds. And this is very important for us to mix these backgrounds. So we have insurance academic researchers, so Caroline and Olivier, and we also have insurance professionals and controller. So we have Philippe Cotel with us, who is board member of the AMRAE, president of the Cyber Commission and risk manager of Airbus Defence and Space. So welcome, Philippe. We also have Olivier Meillan, Deputy Director, Cross-Functional and Specialized Supervision at ACPR. And finally, Luc Vignancourt, International Underwriter, Cyber Risk for Beazley Group. So, as we just said from the talk we had just before, well, it's completely clear that insuring cyber risk is a major challenge today, which make the market of cyber insurance not growing maybe as fast as what was expecting a few months and 3 years ago. So there are several reasons behind that we will explore during this roundtable. Maybe the nature of risk. So is it insurable risk? So Olivier already gave a concrete example on that. The lack of information is also a break, maybe. How to measure what are the stakes. So we will also discuss this point and how to ensure that we have more data sharing. And maybe to start, we can investigate a bit together what we are talking about. So we have seen both on Hélène talk and Olivier and Caroline talk that there is this contagion effect. Some of the questions raised by Marie were about that. So maybe my first questions to all participants, and we can start with you, Olivier Lopez. What is your point of view? Is cyber risk a systemic risk?
In fact, as we said, with cyber risk, you can have huge losses. So you can have a single event that can have important financial consequences. And if you have a high frequency of such events, well, this means trouble for insurance company. But worse than that, you can have, as you say, some kind of a systemic event. That is a large number of policyholders that are struck at the same time or in a short amount of time. And so in this case, the whole system can collapse because the absorption of the risk through insurance is not possible. And that's the fear of a WannaCry of NotPetya type episode, which were probably warning signs in the sense that one has good reasons to believe that things could be even worse next time. And still you have 200,000 victims and billions of euros of losses in the case of WannaCry nonetheless. But as we already mentioned, there are also consequences that go beyond the simple perimeter of cyber risk. If you take Colonial Pipeline, you have an energy provider which is blocked by a ransomware attack, and it triggers fuel shortage in the eastern part of the US. So in the WannaCry case, you have a contagious event which is purely digital, as we said earlier, and in Colonial Pipeline, you see also some kind of contagion caused by a physical dependence between actors. So in both cases, you need to identify these dependencies, and yes, there is a potential of systemic event due to these multiple connections at different levels.
And regarding this precise point, is there any analysis and study you know about that identifies precisely and statistically speaking, let's say, what is incurred by targeting from attackers if they target a specific scope, okay, sector or geography or cloud provider, whatever, and make the difference between that and the effective contagion across connectivity of information systems?
So, of course, you can try to anticipate that, but since you have very few historical data on such massive event, it's of course difficult to have to be really confident in your statistics. But typically, it's the idea of being able to identify this connection. But of course, this can be during a real crisis. You can have some disappointments sometimes. For example, in the COVID crisis, you have examples of supply chains that have been broken, and people did not expect that this kind of supply chain could be broken because they were not careful in properly looking at the connection. So it's in fact one of the fields in which we are searching right now. We are trying to understand as good as possible. Of course, we cannot do miracles, but it's important in order to be able to improve prevention and also to anticipate.
Mm-hmm. And Luc, on your side, did you observe such contagion in the practice of underwriting this kind of risk?
Yeah, I don't say that I will observe some kind of systemic risk in my underwriting right now, but that's true that cyber risk is definitely a systemic risk. One of the biggest reasons, if you just look at behind us for the last 20 years or 30 years, all the company around the world has moved to digitalization. In the same time, they are relying more and more to hosting, third-party hosting company. Now it's relying more and more to the cloud company. And when we have the fire within OVH building, we see that a cloud could be unavailable and could have a fire. So the result today is that all the economic world depend on the IT system. on the own IT system for one company or from third-party IT system. So that creates a real systemic risk that you can imagine that if you have any kind of unavailability of the IT system or unavailability of the internet, we could have a full shutdown of the IT usage around the world. So I think the question about systemic is more a question that I have is when the company has moved to digitalization, to third-party hosting company, to cloud operator, did they take in account all the risk part of this movement of these things? And if they really think about the risk, maybe the view of the systemic risk could change.
Okay. And maybe, Olivier Meillan, what would be your view on this systemic risk topic? And the second question we could ask you to better define what we are talking about is there the typology of cyber risks that you specifically follow at the ACPR?
Yes, indeed, cyber risk is a very important risk for us. ACPR not only monitor this risk through cyber insurance, but also directly through its prudential supervision of the financial sector in banks and insurance. And they are also they are known to base their business of data processing and particularly personal data, so they can become a prime target for hackers. So there is a specific regulation on IT risk for the financial and insurance sector, and we supervise this very closely through different kinds of controls on papers, but also with inside inspection. So it's indeed a very important risk. As was said before, it's due particularly to the massive digitalization of the business, maybe increased also by working from home. There is also a risk of dependencies increased by outsourcing services, and in particular the use of cloud service provider, for example. There are many sources of IT risk in activity of many companies that is more and more connected. So yes, it's a very specific risk, and there is also a part of this risk which is systemic. If a service provider, for example, is hacked, it could impact a large number of companies. And beyond the only cyber risk, this risk can also be combined with market risk. If really a large number of companies are impacted on their IT, this could lead to a financial crisis, we could imagine. So in the worst case, there are a strong implication of this risk, and that's why we are very we contribute very closely with the financial sector and insurance sector.
Okay.
You asked about the typology of these risks. Indeed, and there are different types of risk and different kinds of insurance guarantee also. The different risks like data leaks, data theft, encryption, IT attack, ransomware, sabotage. So a very large number of risks, and corresponding with a large number also of guarantees. different guarantees covering material or non-material damage, business interruption, which is a big issue, civil liability also, and yes, there is a large variety of risk and of guarantee. And yes, in order to improve insurability of these risks, at this stage, there could be areas of improvement for insurer, in particular, in clarifying the risk definition. And to building a statistical basis with a proper categorization of the risk that would allow for a better delimitation of the guarantees and to price them more appropriately.
Yeah. Okay. Yeah. Thank you. Thank you for this one. I think this is key. It's actuaries, they like to model homogeneous risks, so this will tend to drive analysis and modeling by risk type, since we are saying that there are various types of risk. However, and it was already mentioned, one of the main issues for modeling purpose is that there are very few occurrences and a lack also of consolidation of information. On this topic, there was a recent survey that you probably heard about that was performed on the French market. The name of the survey is Lucie. And this is the one survey that provide consolidated first insight on insurance cyber risk with very crystal clear takeaways. Philippe, you were quite involved on this survey and analysis. Could you tell us more on the Lucie analysis, methodology, and takeaways?
Yeah, thanks you very much, Amy, for that. I think Caroline and Olivier were very clear. We have plenty of data. The problem is that we need reliable data. If you look, every 2 weeks, there is a new study about cyber risk, which is emerging, usually by service provider, showing really how intense is the risk and why they need to sell their services to save the world. The reality is that this doesn't really help to have a proper perception of the reality of the risk. And in fact, we took this initiative because by the end of last year, we have many risk managers coming back to us with surprise about the way the market reacted during the last insurance renewal, and they were unable to really understand the rationale about that such a reaction. So we took really the lessons learned of all those different studies that are existing, which are based on survey, on samples that are probably not fully controlled, and we really wanted to do something completely different. So our concerns were that if we really want to have something exhaustive and reliable, we need to address that from the perspective of the companies themselves, the insured. And to do that, we have seen that many insured companies, large corporates, they don't just insure in France. They insure across a number of panel of insurers across Europe and maybe beyond. Therefore, to have a proper capture of the premium paid by those companies and to have that in an exhaustive way, we choose the model to go through the intermediaries, the brokers, who have, and to ask them to provide us a view across their entire portfolio in an exhaustive basis. So we approach 8 of the largest insurance brokers in France, which constitutes probably a very good panel of all the companies using intermediaries in France to buy dedicated cyber insurance. And we ask them to provide us data for 2 years, 2019 and 2020, across the entire portfolio for premium and for claims. And that allowed to have after that we gathered the data all together to have a consistent view of a real picture of all the companies in France who are using intermediaries to buy cyber insurance. Of course, we also highlight the limitation of that choice, especially for the SMEs who may go directly to ventures to buy cyber insurance. However, we believe that as a first step, our approach was really consistent because the main part of the cyber insurance market in France is constituted by large corporates and intermediary corporates. And we were able to measure penetration of cyber insurance market within the economy across the different layers, which had never been done before, with some reliable figures. And that allowed to identify that for the large corporates, what we had a feeling of about that 87% of them are buying cyber insurance, which shows maturity on the model. On the other hand, they buy relatively low capacity, about an average 40 million euro coverage, which for companies, large corporates, which are having dozens of billions of euro of turnover, is a very, very limited coverage. On the end, for the intermediary companies, we see that only 8% of them are buying cyber insurance, despite the fact that the market at that time in 2019 and 2020 was providing offers with, rates that are half of the price that you find in average for the large corporates. So really, the issue for them is more the identification of this resource in order to use that in their risk management policy. What we saw as well is a better understanding of the reaction of the market. And as Caroline mentioned, we saw that effectively we were able to demonstrate premium and claims over 2 years with a loss ratio that doubled and the indemnification which tripled from 2019 to 2020. But we went beyond that because there is not one single average claim. We have access to the distribution of the claims between 2019 and 2020 for the large corporates and for the intermediaries. And that allowed to show that the severity of claims, we had measured 328 claims insured across 2 years, which allows to give a good basis for that the severity of claims has significantly changed between 2019 and 2020. And that only 4 claims alone, which represent about 4% of the full claims of 2020, were sufficient to gather 130 million indemnification, which is equivalent to the full premium of the French market in 2020, only for those claims, for 4 claims, and is double of the full indemnification of 2019 of the French market. And from that point, we draw a number of conclusions and observations about the volatility of the market, the instability of the market, and maybe some reasons of concerns for what we see in 2021. And maybe we can further expand on that if you wish to, Aimé.
So
my last point is that you can find this study, and you can download that for free in the AMRAI website under the Lucie terms.
Okay, so if just first a reaction on large companies, do you think that, and as from your Airbus Defence and Space role, are you satisfied with what you call the more mature offer from insurers?
The point is that we face a kind of an issue. I mean, all the large corporates, they have gone to digitalization, and this is a no return. We will not go back to paper and pen. So it means that this cyber risk is a long-term risk for all the large corporates, and Luc mentioned that already. Well, it's not just for the large corporate, but for all the economies. Mm-hmm. So this is a long-term risk, and in front of this long-term risk, currently the insurance market is providing a short-term, unstable, and volatile answer. And that's really where we have really an issue, because it's very clear that the exposure of the large corporates will just increase over time. It's a fact. And this is something which is more or less predictable, because we know that we will not go back to paper and pen. So we know that, as a matter of fact, adoption of digitalization and increased efficiency of all the process through digitalization imply higher dependency on cyber and therefore higher exposure. It's just a fact. And with respect to this long-term trend, which is absolutely predictable, we need to have a better answer from the insurance market, which is currently in 2021, showing an answer which is decreasing capacity significantly, with no real long-term commitment on the kind of coverage and offer which the market can offer to those companies. So I mean, there is a real risk, MA, for the large corporates mainly, that we have suddenly a clear dissociation between the expectation from the corporates and the offer from the insurance. And you know that what we say is that nature is always hating any void, any vacuum. So there is maybe the threat or the need or the importance of finding other solutions, because we really need, it's a fact, we need to address this long-term perspective, which is unavoidable.
So on this exact question, Luc, what would be your point of view? How could you, as an insurer, address this long-term concern? There are other maybe long-term risks that insurers already deal with.
Yeah, but the main point of this, I would say, cyber insurance and insurance insures the cyber risk. The model of the insurance is based on the mutualization. And to have a good mutualization, we need to have an amount of premium which should exceed the maximum amount of losses to be sure that we can mutualize that. So I fully understand the I would say the comments on the actual market and the actual cyber market, because that's true that we see the capacity which was really decreased this year, and the premium is a lot of increase in the same way. I don't think that we are at the equilibrium now, so I don't think that there is enough premium for the claims that they will come. But I'm not sure that just increasing the premium will be enough. We need to continue to increase the volume of the premium by having more and more insured, which is very important, and especially on the middle market. For large risks, that's true that always all the large risks are already insured. But with the premium of all the large risks, we don't have enough capacity to pay the potential losses of the large risk. So we need really to spread it and to mutualize it across all the market. I'm not sure that if the insurance market will be enough to cover all these kind of risks. So maybe the idea to have another sources of capitalization or another methodology to carry the risk, maybe it's an idea. I don't know where will be the future. But on another hand, we need to decrease the amount of losses, and especially it will be easy to do on the middle market side by improving the risk quality. So I think it's one of the biggest challenges that we have on the cyber market right now. If you look at on an average on the middle market size, the level of the security, the quality of the risk is not good enough to be insured.
And how to make it move? How to make it move toward better quality?
I think it's already on the way to improve. There is a lot of concern by by authorities, by consultancy, by company, and by the companies too, because they see that they can have a ransomware attack. It could hit everybody. Doesn't matter the size of the company. Doesn't matter the location of the localization of the company. Doesn't matter the activity of the company. So now everybody know that it could be hit by a ransomware. So we can try to how can we protect all the company against ransomware? We know that ransomware go inside the company by open ports on the. So maybe just close the open port when it's feasible. So there is a lot of technical issue which could be improved, and to bring this market at a better level.
Okay. Any other views on how to improve the middle market?
Yeah. So if I may comment on Luc and I share most of what he just said, is the fact that we see clearly from the Lucie perspective that we need a better balance of the market to address the severity of claims, which is growing. And clearly, the reduction of the capacity will constrain very much the volume of premium. And that's really, for me, why a balance only on the large corporate is difficult to achieve by the cyber insurance market. That's why the key element is to address what is the core of the economy, the medium size companies, for which they were probably not fully mature, not fully aware of that cyber insurance. And currently today, what they face is that those who wish to try to go to insurance, the point that the technical requirement that have now imposed by insurers to them put them, probably most of them, to be not eligible to insurance, which is a lose-lose situation. A lose situation for the companies that are not covered, and lose situation for the insurers who miss this mutualization effect. So what we have proposed within the initiative, where we have also, ACPR Olivier is fully involved in that, is we have put on the table a proposal where for that level of, that size of the economy, we put all the experts on the technical side, the CESA, CIGREF, and to develop standards of cybersecurity maturity defined by size and by activity for those sectors of activity, and from those standards of maturity, develop some audit criteria which would allow, through the help of the public authority, to be spread widely across those heart of economy, to help them to, first of all, be aware that they have a cyber issue, which for most of them are not. Secondly, to help them to identify really the investment way to reach a level of security which is consistent with their size, with their activity. And there's also another difficulty, that for those companies who have not the technical expertise, they are bombarded with service offers from many companies, from many consultants, service providers, and they have no clue whether this offer is the right one or that offer is the right one. Do they buy something which is really useful, or do they buy something really extra which is not useful for what they need? And that prevents them really to go the next step. So if we help them to better understand where they are, better understand where they have to go to be at a level which is consistent, to be pragmatically sufficient for their level of activity, the more they will effectively be able to be eligible to have this last step of the point, which is the insurance aspect. So let's go step by step, not just by insurance, but really identification, prevention, insurance in a consistent way across the globe, across the scope. And it is also a question of sovereignty for France and for Europe, in order to make sure that we have the right tools to evaluate really the security standards that are pragmatic and addressing really what we need, as a matter of fact. So that's the proposal we put consistently on the table to the French Ministry of Finance.
Maybe in a row, Olivier, your reaction on that, and on the perspective to start, to accelerate within Europe, and maybe mutualizing with other countries. And then we have to switch to the other big topic of this roundtable, because we have a few times ahead.
No, yes, just a few words to confirm that there is indeed a need for raising awareness and educating stakeholders on cyber risk, both from the policyholders themselves, firstly, but maybe also from the trade forces of all insurers. And it implies, in particular, a strong coordination between the promotion of insurance products and the preventive measures that have to be set in place. Yes, several national authorities also have an important role in preventing cyber risk. The National IT Security Agency, ANSSI, which focuses on the largest company with vital or essential importance. for the country. Also, there is a publication group against cyber malevolence, GIP ACIMA in France, which focuses on the largest, broadest panel of stakeholders, individuals, companies, associations, administrations also.
Okay.
Yes, there are many there are devices that are set in place, and I mentioned before the role of ACPR with the financial and insurance sector themselves. So many French authorities and European authorities are involved to combat the cyber risk and the phenomenon of maybe under perception of cyber risk by some companies, possibly small and medium companies.
One last point, maybe, Aimé, if I may, and I'm sure I will ask. I mean, what we aim for Lucy is to create a reference, allowing a better dialogue between all the parties. And I think, in all fairness, that all insurers in France, brokers in France, and risk managers in France are aware of Lucy, and they are using that as a tool for better dialogue, which really was our aim. And also, we really want to expand that across Europe. So we are launching the same analysis. So of course in France to make sure, and 2021 will be a very interesting year to follow, but also in other European countries in order to really continue this spread, because we are completely convinced that this is the right way to serve the business overall and all the community.
Okay, thank you. I would like to switch to the modeling challenges topic, which is also very important. And it is quite linked to the availability of data, of enough data. So maybe first question for Caroline and Olivier. So you presented several modeling tools, extreme value theories, ROG processes. Maybe Caroline, what would be your top one recommendation to be used as a toolbox among these methods for actuaries? I don't know, Caroline, we cannot hear you. Maybe you are still on mute. So probably a connection issue. So maybe I will ask this question to Caroline. Are you back? Olivier, is it my connection?
Yes, do you hear me?
Yes, we can hear you. So the connection still seems unstable. So Olivier, maybe what would be your point of view on that?
Do you hear me?
We cannot hear you very well.
Yes, maybe I can try again.
Yeah, it's better now.
Yes, it's better.
Okay.
The question?
So, yes, I hear the question. Sorry for that. So concerning the modeling, in fact, we have a lot of mathematical theory and probabilistic and statistic tools. And the main challenge for me is to be able to customize and adapt this methodology to cyber risk, and as Olivier already mentioned, to be able to feed these models with reliable and accurate data. So in the toolbox for the severity components, the severity analysis, we have, of course, extreme value theory. It is important to be able to draw a line between claims that are insurable from ones that are not. And we have also seen in the presentation of Olivier that this line is even more difficult to draw because of the heterogeneity of the risk. So we will statistics tools and data science tools to be able to do some classification of the risk, for example, trees, regression trees, classification trees, or random forest. So we also lose the independence between policyholders. So we need more to adapt the model, and this leads also to computation challenges, because when we lose independency, it's more difficult to compute premiums and so on. But here again, we have mathematical tools, for example, Maliavin calculus, that are able to give some expansion formula to still provide some pricing in this context. So in the accumulation, we have seen a lot, some example with the epidemiological model. So here again, the main challenge is to adapt, to customize this epidemiological model to cyber risk, because the cyber pandemic has not the same feature, has not exactly the same characteristic as a biological risk, as a biological pandemic. And maybe just to finish with this risk that evolves very fast, we need dynamics models, and we need to be able to monitor the risk and to detect quickly when the risk deviates from too much from the prediction. And here again, we have some tools of mathematical algorithm. Let's say the Kuhn-Sum algorithm for cumulative sum, which is an optimal algorithm when we want to detect an increase in the claim intensity when we consider a criteria of on the false alarm to limit the criteria on false alarm. So this is yes.
So this is not the top one, but the top 10 tools that could be used. So now on the side of maybe more professionals, operational experts here, do you use any of these tools? Extreme value theory for underwriting, for instance? So this question for Luc.
Yeah.
Or Philippe.
Yeah, I will try. Yeah.
Listening carefully.
Probably Philippe will use some tools to evaluate his exposure to cyber risk. But on an insurer point of view, if you just think about NotPetya, it was 2017. The company which was eaten by this NotPetya was in every kind of country, every kind of activity sectors, any kind of size of the company. So definitely we cannot evaluate or use the activity or the region like a model to evaluate your exposure as an insurance company. If you think about the monopolistic situation of some operating system, you think about the connection to internet. There is 36,000 ports to connect an equipment to internet, and there is only, we see in our statistics that we have 4 which are always used by hackers. So there is so many common points that you can find everywhere that is very, very difficult about talking about modeling. Think about cloud operator dependency, hosting companies, DNS providers. All these things make that I don't know if it's possible to use kind of model. I will say for an insurance company, maybe the only one model is the total loss of the portfolio, but I will not say it too highly.
Well, I mean, as far as we are concerned as an insured company, I mean, we were developing through Airbus, and we developed that quite globally, is the fact that if you can't measure, you can't manage. It's as simple as that. And one way to really measure is to measure financially the impact of cyber. And so what we have developed through our model is to go on a business perimeter and to develop really some catastrophic scenarios addressing on that specific perimeter, validated by the business and validated by security, and quantified really by the controllers of the business. And my conviction is that if you really want to go that route, you cannot just be security focused. It's really business impact, which is really the driver of identifying what are the key vulnerabilities of the business, which would have the highest consequence, and to see whether those vulnerabilities could be susceptible to be attacked through cyber means. And that's how we were able to really drive scenarios validated by the business and then validated by security. And to some extent, as Caroline mentioned, more and more the attackers are not just IT experts. They are business experts who know exactly the target, where to hit, and they are then using technical means to go to that target. So that's really what I think we went to that, and that allowed top management to become very aware about the financial impact of those scenarios and to be able to drive the investment in order to reduce that accordingly. So that's really the way at insured level in a risk management approach, identification, quantification, and mitigation, which is a key aspect in order to make sure that we have a proper risk management strategy.
Okay, great. Thank you very much. So we are already running out of time for this panel. So thank you all for these great discussions. I would say the major takeaway from this discussion is that the case of insuring cyber risk still need to be cracked. It's still not the case. And this is critical given the prospective element that you just shared. So maybe Marie, you want to conclude this session?
Yes, very quickly, because as you said, we are running out of time, but I just would like to thank you. Thanks for a great moderation of the panel, and to all the panelists. I learned a lot during your discussion, so that was really great. And I hope to see you soon for a next event organized by ACPR and the Finance and Insurance Reloaded program. So probably in February. So thanks to all of you, and see you very soon.
Bye.